And we're live. Thanks everyone for joining today. Nice to see some of you here. Great. So Shanky, tell us, why are we here today? What is Going Elliptic?
Yeah, absolutely. Well, firstly, it's an exciting day because it's our episode 1. This is the very first one. And, Paul and I have been working together and we've been enjoying a lot of good crypto content, and we haven't found that out there in the wild so much. And so we said, you know what, we should put together a show which is very focused on content and conversation and bringing on these experts who know the good stuff and share that out and avoid all the other sort of, the buzz and the jargons and the shilling, keep that out and just focus on pure good content. And that is really what Going Elliptic is about, right? That's a story, and that's what you will get in the show today, and that's what you will see in the next multiple episodes that we're hoping to bring out for you. Now, before we jump into today's show, I think it definitely makes sense to introduce ourselves, to tell you folks who we are, and and then jump in and roll things out. So I'm Shanky. I spent a lot of my life, early part of my career on Wall Street, building a lot of trading applications, risk management systems, algo trading stuff. And then for the last decade or so, I've been deep in the world of startups, just having some exciting run around scaling and distributed systems and startups at large. And when I was first sort of learning about crypto a few years back, what really got me excited was that it was a fantastic sort of merger or bringing together of these two worlds, the exciting world of Wall Street and then the exciting world of technology and scaling in the future. So it's really sort of interesting and exciting from a standpoint of somebody who comes with a background. And I jumped right in and I continue to learn every day. And we are hoping that as a part of this show, we also bring those kinds of content to other people and share and grow together. So that's my story. But, Paul has a very exciting background in the world of blockchain and technology and crypto. And let's go over to that, Paul. Tell us about that.
Thanks. Yeah, my background, when I found Bitcoin in 2012, I fell in love with it, and I've started several companies really around the building side of it. And then started specializing in smart contract security audits. Around the time that Ethereum launched, there was a very high-profile hack everyone remembers, and that was like a wake-up call of, okay, somebody needs to make sure people aren't losing money. And I've been so focused on that actually I've kind of not paid as much attention to how are people making money. And so in this Going Elliptic series, I think it's going to be really fun to learn from some of the best traders, investors, founders, like why are they building what they're building, or how are they, building their businesses around crypto and their journeys kind of going elliptic. And I think educational wise, like Shanky said, this is going to be knowledge sharing. We're not going to show anything to you, and hopefully, we learn something as well. With that in mind, if you hear something that you really like, give us a thumbs up or drop a comment into the live stream, because that way we'll know that it's really insightful for you, or it's something you've learned something fresh, and we'll keep tailoring towards that.
Absolutely, yeah. So yes, please do give feedback. This is meant to be conversational. Like, subscribe, ask questions. There'll be a moment, in fact, in the session today and in every future episode where users can ask their questions, and our guest will answer them, of course. Okay, with that said, let's give a little introduction about our excellent first guest, Bharath Rao. He's the founder of Leverage.io, a decentralized DeFi infrastructure and derivatives trading platform. Today, we have him not to speak so much about leverage, but about some, trading ninja tricks, if you may. All the things that he has tried out as a derivatives trader in the past, and all that he can share with the audience here today. He's been in this for a long time. We'll hear a bit of that from him as well, for almost a decade, and has seen both the Bitcoin and the Ethereum infrastructures up close, and built some interesting trading strategies and observed the crypto markets. And we'll see what he shares with us today. So with that said, Paul, are we ready to roll him in?
Yeah. Hey, Bharath.
Hey, thank you guys for having me on. As you know, as Shashank said, I have been in the crypto world since 2011 or so, built companies and so on. But I think most people know enough about that. As a trader, I've actually been trading for a much longer time. I've been trading since '96, which is when I was a student. And I've traded nearly every kind of instrument. I have lost a lot of money. I have made money. I've traded penny stocks, futures, options. I mean, you name it. I've done everything. I've blown accounts. I've gone away from the trading for a couple of years. I've been through the entire emotional journey that a trader goes through. So I can, I'm happy to share my insights and experience with you guys.
Absolutely, yeah. Tell us
Thanks.
how
Yeah.
not to blow as well when you talk through all your good stuff. Yes, Paul, let's keep going.
Cool. Yeah. So, I mean, one of the first questions we wanted to really put out there for you is, obviously, a lot of your recent experience has been around trading crypto perpetuals, but why do you think it is that perpetuals have become such a dominant industry in the crypto trading sphere versus the traditional trading environments?
Right. I think there's a few reasons for that. The first one is, that most exchanges are still centralized exchanges, and there's always a risk of, there's a third-party risk or a counterparty risk, and it is much more easy to just put, say, 1 to 2% of your actual net worth and trade. Most traders have a permanent long position. So they want to, take short positions or offset their risks, and it would be highly dangerous to put all their worth, which could be substantial, into any of these exchanges. Even with the smart contract based trading which we have now on Ethereum, there's still a little bit of risk with the contract, some contracts being hacked and so on. So that is one. The second reason is capital efficiency. You are able to lend your capital and earn interest, or any other any other thing you want to do, while using only the smallest possible capital to get your trading done. So I think that's the major reason perpetuals are popular. One of the other reasons perpetuals are popular is that people want to trade like they're trading spot. So they don't want to deal with the expirations, rolling over, and so on. Even in the world of the traditional finance, people prefer, a lot of people trade what's called rolling futures or continuous contracts, which essentially does the rolling for them automatically. So it's and essentially once you don't have to worry about rolling over and things like that, you can build other instruments on top of it. You can just use that as a permanent hedging place where, if you're market making somewhere else and so on. So yes, perpetuals are essentially the foundation of all crypto derivatives trading, and they're here to stay.
Great. And you touched on there a little bit. It brings us into things like leverage trading, and that's.
I think
and you love leverage trading.
Paul's voice is a bit choppy. Maybe Shank.
I'm going to jump in here a little bit. Paul, looks like your connection is getting a bit choppy here, so maybe while you sort of fix that out, I think what Paul and I were both wanting to definitely get started with today is really around leveraged trading. So you've got that in the name itself, in Leverage.io, and we're not talking about Leverage.io today, but do tell us and show us, more than just telling us, what a leverage trade is all about, and how does one enter it, what's the right way to deal with it. And I think that's something that we would definitely want to learn today as a part of this whole sort of broader show and tell episode. So take over, Bharath, and tell us a bit more.
Right. So leverage trading, essentially is a way of just depositing margin, and you're just hoping that your profits and losses are within that margin, and if not, your position can get liquidated. Essentially, it will be swept by the trading facility, right? So what leverage actually gives you is it enables you to amplify your returns. So whether it's positive returns or negative returns. So a good trader can multiply their wealth very rapidly. A bad trader can lose all their wealth very rapidly. So leverage is a double-edged sword. It's extremely dangerous, but it's extremely powerful at the same time. So you need to know how to trade it. The one thing that people who come from just spot trading background that they don't understand is that in leverage there are additional things you need to manage other than just your position, right? So you have to manage your essentially you have to manage your margin, and if you really want to be successful, you have to manage your risk. And now there's many different kinds of risk. When people talk about risk in a trading, they're talking about your risk when your money when you have an open position, the risk of that position. There are other kinds of risks like counterparty risk and third party risk and all of that. We're not going to call them, we're not going to talk about them right now. So those are the things you need to do, and the simplest way to do that is to learn how to use stops properly. You have to learn how to enter and how to exit. Now, when I say how to enter and how to exit, it's not as simple as in spot where you can just buy anytime you want and sit on it and just wait for the price to go up. In leverage trading, you need a lot more skill, and you need to develop two very important skills, right? One is to get a sense of direction. The other is to get a sense of timing. In spot trading, you don't need that. You just need to have faith, or you need to have some kind of analysis that tells you this particular asset is going to increase in value, and or decrease. But that is the short side. You just have to. It's just the inverse of the long side. So for simplicity, I'll only talk about the long side. So in a spot trade, you just buy when you think the price is at a discount, and you just sit on it. And it's really your patience and your understanding of the value proposition and the market and all that. In leverage trading, all of that doesn't really matter that much. What matters is your sense of direction. So most people do not actually have when they start out, they won't have a sense of direction. So, and the way you know that is they will have hundreds of trades, and they'll have a very small profit, or they'll have a big loss. And this is because they see a bar, they see a green bar, they get excited, they buy, the price action moves against them, they panic, they sell, they made a small loss. Then it again moves in their favor, they yell at themselves, they go along again, and maybe this time they get a little profit. And essentially all they're doing is they're churning their account and making money for their exchange or for their broker. They're not making money for themselves. This was what my first experience with trading was. I had made first day of my trading, I had made $420 of profit, out of which 400 went to trading fees. So, and this is why a lot of these exchanges and these trading gurus, they try to teach scalping, because it actually makes money for them. It doesn't make money for you. But a sense of direction is in the sense that you have to be when you have a risk, if the price moves against you and your risk, essentially your stop is taken out, if that happens repeatedly enough, your account will bleed very, very fast, because everything is amplified. And what you want to do is you want to enter setups which have a high probability of success, like at least 60%, preferably 70 or more. Mm-hmm. And you want them to retrace as little as possible. To give an example, let's say I'm just going to daily chart here. So what I do, for people who are new, I just encourage them to trade only trends and not trade chops. If they only do this, their trading will improve, dramatically, right? So, for example, this is a trend, and how do you know something is trending? The chart starts at one corner and proceeds to the opposite diagonal, right? So it's a diagonal.
Or the other way around.
Yes, or if it's short, it's from top left to bottom right. Yeah. And anything else is a chop. So, for example, this is a chop. This is very, very difficult to trade for beginners until you get sufficient expertise. But this can also be traded, but we'll talk about it later. So in a trend, the simple thing to do is whenever there's a deep pullback, you can just enter on the trend side. So here you can really buy any red bar, right? You can buy the close of any red bar and hold it long enough, it will go up, right? So nobody so far has lost money except maybe the people who bought these final red bars. In reality, you wouldn't buy every red bar. You would buy a deep red bar, and something like here or here, and then it will go up. So you will know the where professionals buy, because normally it will never retrace more than a few ticks from that point. So this, for example, is professional entry. The price never really retraced below it. Okay, so people who bought here and all these are amateurs. They didn't have the patience. They didn't wait for the full retrace to complete. They looked at this bar. They gave it some names. They called it pin bar, this and that, or they call this an inside bar. They bought on the breakout the inside bar. These are all setups, by the way. These are all. There's no incorrect way to trade if you know what you're doing, and if you don't know what you're doing, there's no correct way to trade. Right. So that's essentially the problem. So you could just buy this bar here, and it would continue to go up, and when there's a nice big push, you can sell. So when I say when this push sell, the thing I have not said so far is that since your primary mistake is overtrading, you have to control that, and a simple way to control that is to act only on the close of bars. Okay, so that way, even if you're trading an hourly chart, at the most you're going to make 24 mistakes a day, right? Not more than that. People who trade prices, they will end up making a lot more mistakes. So for example, here at a certain point, this bar was all red, and this inside bar here was both a green bar and a red bar. So if you trade in between bars, you will make a lot of mistakes. When the color of the bar changes or the shape of the bar changes, you will panic. You will you will FOMO. You will just you'll get shaken out of your position. You'll get into positions that you wouldn't have gotten into if you waited for the bar to close, and so on. So just waiting for the bar to close is an amazing value multiplier for your trading.
So Bharath, I want to jump in here a little bit because you make some excellent points, and I'm sure that people would want to double click and dig in a bit more. One, you mentioned about different time frames, and within the particular time frame that you are interested in, make sure you at least let the bar close, the bar complete. So definitely tell us a bit more about the time frames themselves, and then of course also show us some entry criteria. So you've already spoken to it in terms of when is a good time to enter and possible good time to exit, but also maybe pick one of these parts of the chart, whatever is your favorite, and show us a little bit more of where you would enter, where would you exit, why, and tell us a bit more there. Yeah.
Right. So there's a lot of foundations of trading itself that probably we could cover in a different episode. Most people do not, they're just they're attracted to the volatility, and they say, well, everyone is making money, let me make money. But essentially, there is foundations of trading that people need to know. Let's touch upon that on a different episode. So sure. To answer your question about time frames, time frames depend a lot on the instrument, the trading hours, the volume, the how strong the trend is, what is the volatility. All of these determine what kind of time frame you can trade on. So, for example, in the traditional futures markets, you have 9:30 Eastern to 4:15 Eastern, and if you want to get enough bars to trade, and most of the price action is in the early morning, you can only trade something like a 5-minute chart. You cannot really trade slower than that. You won't have enough bars to trade before. So after lunch, a lot of times nothing happens. The problem is, the shorter the time frame, the worse the quality of signals, and that is very easy to understand, because one or two data points, one or two trades can make a bar. Whereas in a larger time frame, there needs to be a lot of trades, and there needs to be a sustained movement in a direction for the bar to have any sort of meaning. So in my experience, beginners should only trade daily charts. Okay, and if you're in like Eastern Europe, or at a place where the bar closes at a inconvenient time, you can trade like a 4-hour chart or a 6-hour chart or something like this, right?
Okay.
And the good thing about crypto is that it's a continuous market. It's a 24-hour market. So you can easily, so for example, this is a daily chart. I can trade this as easily as I would trade a 5-minute chart in the fiat world, but I would get higher quality signals. So this is the great thing about crypto, right? So another thing to note is, when the slower a market moves, the slower your time frame should be, and the faster a market moves, the faster your time frame can be. So, for example, if the market is exploding, in the just before the market turned in 2017, right? Like in the last 2 or 3 days, the market essentially doubled in value. So if you are trading a daily chart, you just would be lost. It would just, by the time you get in, the market would retrace completely against you. So in those cases, you can trade smaller and smaller time frames, even 5 minutes, even 1 minute, when it's going crazy. But normally, I would suggest everyone start with daily chart, and only once you're successful, you go to smaller and smaller time frames. In general, there's no need to trade less than 1 hour, unless the market is moving really, really fast. Like when market moves fast, yeah, you can definitely trade 5 minutes or even 1 minute, and you will notice that the reason you can do that is there's so much more data points, there's so much more trades in that minute, that it would be equivalent of a normal 1 hour bar, right? And that's what makes it. So that is how you trade. That is one criteria to choose the time frame. The second is in which time frame the market is trending. So right now here, for example, on the hourly, this is chop, right? This is starts in the middle of the chart and it's ending in the middle of the chart. There is no real trend here. So when there's no trend, all your trades are risky, because see, in a trend, what happens is the probability of a with trend trade is much, much higher than the probability of a counter trend trade. But in a chop, everything is 50-50 or less. So you can. So for example, if you think that, hey, this is going down, and enter a long position here, enter a short position here, what may happen is that this may be the start of a new trend, and it may continue to go up, right? Similarly, if you think that, well, this is a pullback, I'm gonna go long, this may drop. So it's very hard to judge, hard to have a sense of direction. So remember, yes, you need a sense of direction and sense of timing.
Yeah, absolutely. Hey, Paul, we see you back, which is great. Yeah.
Yeah, sorry about that. Right. Well, yeah, one of my questions for Bharath was like, what is that absolute ninja move that you're really proud of, or you're, fisting your pump fisting, like, yes, I pulled that off. What is that move for you?
All right. So when you are a seasoned trader, you generally don't get emotional about your trades. You could be making the equivalent of yearly salary in a trade, or losing a yearly salary shouldn't move you much. Okay, but back in the day when I was trading ES futures, I could actually trade the exact turning point for the day. I could trade the exact low or exact high of the day. Of course, in crypto, there's no high and low of the day. So in crypto, what I'm generally able to do is I'm able to exit, very close to a major turning point, right? So either, so I would probably exit here in this case, and I would probably go long here. So in general, I have sufficient experience that I'm able to capture the most value from a move, right? Now this is, I'm not saying this is a good thing. In general, you should not manage prices, you should manage risk. So in other words, if you sold here and you buy here, you not buy here, but I'm just giving an example. You lose a little bit in price, but you eliminate a lot more of this downside risk. Okay, so I'm able to do that pretty successfully, and it's fairly straightforward. It's just when I'm, and it's an emotional trigger. Like when I feel very proud of how much I have accomplished, I take a profit. Right? I don't go around telling everybody, calling up old ex-girlfriends and saying, "Look how much money I made." No, these are signs that you should sell and get out.
Well said. Yeah. Do we have questions from the audience, Paul? Otherwise, I can, definitely I do want to ask Bharath at least a couple of more things.
Yeah, jump in with yours.
Okay, excellent. Yeah, and if you do see a audience question, we can put that right in. So the other part that you mentioned, Bharath, which is obviously, you don't necessarily want to time the market. You have your own risk parameters, you have your own strategy, and you let it play out, which is seems like the right advice in general. Or the right way to approach the market. Tell us a little bit more in terms of the whole sort of stop loss strategy. How do you approach that? How much of sort of breathing room do you keep? What's the right way to do it? And especially in the context of PERPS, right? Where
So there is there are many ways to do it. Let's put it this way. There are many valid ways to manage the risk and manage the stops. There are people who have fixed stops, which means that regardless of where they enter, they have so many ticks worth of stop. If the price moves against them by so many ticks, they're out, right?
Mm-hmm.
That's a valid way. One second. So that's a perfectly valid way. There are other people who have a trailing stop. The same idea. They have a fixed number of ticks, but they trail it as the price moves in their favor. I feel that all of those are okay if it works for you. But in general, I like price action stops, which means, so let's say I enter. So generally in a bull trend, I enter on the close of a bear bar. Okay. Of a nice deep bear bar. So I ignore all these bars with a lot of tails. They're not attractive to me. And generally what that tells me is that, so when I see a big bar like this, a lot of people get excited and buy. But for me, when I see a bar like this, it tells me that people will sell above it and buy below it.
Mm-hmm.
So I like to see a close below this bar, and that would happen here. So I would buy the close of this bar, and as you see, no one, it never went below that after that. Okay, it went all the way to here. So that's why I call this a professional entry, and everything here I call it an amateur entry. So if I buy here, my stop typically is the swing low below, just the swing low below that, whatever is the swing low. So in this case, it will probably be this, or if someone could put a swing low before the high that leads to the pullback. So a lot of people also put a swing low below this. Okay. Now, if you are very experienced, you can actually put a swing low below this red bar itself. This is very aggressive. Okay. And you can do this in certain kind of setups, like for example, in a double bottom scenario, you're not expecting the price to go even a little bit below the where you enter. So there you can have a tight stop. You can enter on high leverage. All of those, you can take max risk there. When you are, let's say, accumulating the dips, for example, here, you see this price going down, you buy here. You don't actually care if the price goes down here, because you have a lot more capital that you want to deploy at this price. So for example, if you divide your capital into 10 buckets, here you bought one bucket, The second bucket is going to be bought here, and so on. So that is how, that's how I would do the stops. I would, depending on how choppy it is, I would generally put it. The safe thing to do is put it below this is the safest stop. The swing low below the high that led to your entry. This is the safest one. If you are aggressive, you can also put it here or even put it under here. And that's how you trail it as well. Every time there's a new high, so let's say it goes above this high. So all of these are not new highs, by the way. The new high is the high above this. So when it breaks above this, you can move your stop to under this red thing. Okay, so and you can keep going. So what would happen here is your stop would move below this red, or at least below this red, and you would get stopped when this takes you out. But normally I don't do that. I don't let the stops take me out. When there's a nice big move up here, I would exit it. And there are ways to know whether exit on this bar or this bar. For example, if this is a breakout bar, and why is it a breakout bar? Because you see, it has closed well above and above the previous high, and half the bar is above the previous high. So this means you can expect that the price is going to move at least that much higher, somewhere in this line. At the length of that bar, you can assume that it's going to double, so it's going to come till here. So I would probably have exited at this point already. So my stop would never be hit. So in general, my stops are never hit. If it's not hit in the beginning, when right after I enter, generally it's not hit. I generally exit on a big bar like this.
All right, and we've got a question in there from one of the listeners, which is, what is ADL? How does it work? And to extend on that, how does that impact your trading strategy with some of those stops and the amount of leverage that you're using?
Right. So ADL is so in the traditional markets, what happens is if you can lose more than your margin if the market moves rapidly against you. For example, ES, there's a $500 or something like that margin requirement, but let's say the price gaps and you are now you now owe like $2,000. The law will require you to submit that that difference, and if you don't, then there's legal action. Hold on a second, there's some noise here. Right, so they would collect it, and there's clearing and all of those issues, all of those agencies that take care of making sure that the winner is paid. So what happens in crypto is that if you lose more than your margin, there is no way to enforce it. So what happens is, right, an opposing position, a winning position, is closed in profit to ensure that no one ever gets into a negative balance. So that's called ADL. And the ADL actually doesn't impact the loser that much. It impacts the winner because his positions will be closed. So the way to deal with that is always, when there's a nice strong move in your favor, take a little off. Take additional little off. So the more, the stronger the trend is, the more you can really let it run, but the more likely you're going to have ADL. So every time there's a nice big bar, you should take a little off. And
right, so kind of almost deleverage or reduce your position size yourself before the ADL kicks in.
That's right.
Correct. All right. Well, yeah, we're going to go through some rapid fire questions now to round things off. I'll bring them up one by one on the screen, and let's go. So which of these two would be your first choice to trade, perpetuals or options?
So I think for me, perpetuals is better, but for a lot of beginners, options is better, because with options, you don't worry about managing risk. Your risk is your premium, whatever you paid for your option. And the price, you can never lose more than you put in. The price can go up and down. It can, normally what will shake you out, you wouldn't get shaken out because you already mentally accepted that as the cost of doing that trade.
Yep.
but to learn how to trade, leverage trading and all of that, I think Perpetuals is something that is a very, very good instrument that that teaches you how to successfully trade in any market. I'm talking about any market, whether it's traditional market, commodities, stocks, like anything. I think Perpetual is a good place to learn it.
Great. In one word, what's your biggest fear when trading?
My biggest fear. So
One word.
I don't really have fears anymore. But my biggest fear would be essentially that I will get emotional and I will get shaken out of a good position. This is my biggest fear.
All right. What's your favorite altcoin to trade?
So for a trader, there's only two things they care about: volatility and liquidity. And other than Bitcoin, obviously Ethereum is the top altcoin to trade.
Nice. And complete the sentence. DeFi makes
so much sense.
That was a good one.
Yeah. Great. And last but not least, describe leverage to our listeners in 60 seconds or less.
So leverage is low latency, high speed derivatives exchange where you have a centralized fee but a non-custodial security.
Fantastic.
Excellent. Yeah, that's great. Well, you did very well, Bharath. It was great chatting with you today. Of course, as you yourself mentioned, we wish we could have covered more, but perhaps we'll definitely have a follow-up session and we can pick up subtopics where we can just drill deeper into it and get lost into the details of liquidation and stop loss and trading strategies and drawing charts out and everything else.
Yeah, I think this is a good introductory thing where we touched upon a lot of topics, but everything I said, it could be its own session. The whole entry, the whole risk management, time frame selection, multi-time frame analysis. There's just a whole bunch of stuff, and each of them would take a significant amount of time, and some of them may actually take more than one session if it's of this length.
Yeah,
we'll do it.
Perhaps we'll have you back as well. And yeah, definitely really value everything you've shared in today's session there. So thank you. Obviously, thanks also to the listeners who have tuned in. And don't forget to subscribe so you can be alerted by YouTube when it's the next session that's going. And yeah, that's it for today. We are going elliptic.
Absolutely. Going elliptic. Thank you.
Thanks, guys. Bye.